Let's dive into the estate tax, a topic that often gets overlooked until it suddenly becomes very real for families. Whether you're just starting to think about your legacy or you're already deep into financial planning, understanding the estate tax is essential for anyone who wants to protect what they've built. Estate tax is often seen as the government's final invoice after you pass away, but it's much more than just a bill. It's a set of rules that can shape how your assets are passed on, and it can have a big impact on your loved one's financial future. At its core, it's a federal tax on the total value of your estate at death, including everything from your home and investments to personal belongings. This tax can affect what you leave behind for your heirs, and how smoothly that transfer happens. Thankfully, most Americans won't face this tax due to a generous exemption amount, which means only estates above a certain value are taxed. For many, this provides peace of mind. However, if you've amassed significant wealth or expect to in the future, it's crucial to understand how the estate tax could affect your plans. Even if you're not there yet, rising property values and investments can push more families into taxable territory. The rules are always evolving, and knowing the current landscape can help you make smart choices to protect your financial legacy. Changes in legislation or exemption limits can have a major impact on your estate plan. This isn't just an issue for the ultra-wealthy. The thresholds and regulations are complex, and they can change with new laws or economic shifts. It's important to stay informed, no matter your net worth. In this chapter, we'll break down how the estate tax is calculated, the important role of gifting during your lifetime, and what upcoming changes could mean for you and your family. Think of this as your guide to navigating the complexities of wealth transfer, so you can make confident decisions and avoid costly surprises. Understanding these elements ensures your assets are distributed as you wish, not by default IRS rules or court decisions. With the right knowledge, you can shape your legacy for generations to come. Let's demystify the estate tax together and help you make informed, empowered decisions for your future and your family's security. Stay tuned as we explore practical strategies to safeguard your financial legacy and ensure your wishes are honored. How does the IRS determine if your estate owes tax? The process may seem complicated, but it follows a clear set of steps designed to ensure fairness and accuracy. It all starts with calculating your gross estate, which is essentially a tally of everything you own at the time of your death, no matter where those assets are located. This includes cash, stocks, bonds, real estate, business interests, vehicles, valuable collections, and even certain retirement accounts. Some life insurance policies are also counted, especially if you owned them or had certain rights over them. After you've determined the gross estate, you can subtract allowable deductions. These include outstanding debts, funeral expenses, administrative costs, and certain legal fees. Charitable donations and gifts to a surviving spouse can also reduce the estate's value, sometimes significantly. The result is your taxable estate, the amount that's actually subject to federal estate tax after all deductions are taken into account. Next, the IRS applies the lifetime exclusion amount, which shields a large portion of your estate from taxation. For most people, this exclusion means their estate won't owe any federal estate tax at all. If your taxable estate is greater than the exclusion amount, only the portion above the exclusion is taxed, and it's taxed at a flat rate of 40%. Understanding these components is key to effective estate planning, as it allows you to make informed decisions about your assets and legacy. To recap, you start with your gross estate, subtract all eligible deductions, and then apply the lifetime exclusion to see if any estate tax is due. If your taxable estate falls below the exclusion threshold, you owe no federal estate tax. If it's above, only the excess is subject to tax. This means careful planning can help minimize or even eliminate your estate's tax burden. The lifetime exclusion is a powerful tool, and understanding how it works is essential for anyone looking to preserve wealth for future generations. By knowing these steps, you can better navigate the complexities of estate tax and make choices that benefit your heirs. In the next section, we'll explore how strategic gifting can further reduce your taxable estate and help you achieve your estate planning goals. You might wonder, why not simply give away your assets before you pass away to sidestep estate tax? This is where the gift tax comes into play, acting as a safeguard in the tax system. The gift tax is designed to prevent people from avoiding estate tax by transferring their wealth to others while they're still alive. It ensures that large transfers of assets are still subject to taxation, even if they happen before death. When you make taxable gifts, the value of those gifts reduces your lifetime exclusion amount. This means that the more you give away during your lifetime, the less you can pass on tax-free when you die, potentially increasing your estate's tax liability. However, the IRS allows an annual gift tax exclusion, which lets you give up to a certain amount to as many people as you want each year, completely tax-free. This annual exclusion is a powerful tool for families looking to transfer wealth gradually. Gifts made under this annual exclusion don't count against your lifetime exclusion, so you can use both strategies together. This offers a smart, strategic way to transfer assets to loved ones while minimizing taxes. Imagine your lifetime exclusion as a large bucket, and the annual exclusion as smaller cups you can fill each year. By using both, you can maximize the amount you transfer tax-free. Effectively combining these exclusions can significantly reduce your taxable estate, helping you preserve more of your wealth for future generations. Understanding how these tools work together is crucial for anyone interested in minimizing future estate tax and making the most of their financial legacy. Next, let's explore the concept of gift splitting, a strategy that can further enhance your gifting power and help you make the most of these tax benefits. The annual gift tax exclusion is a powerful tool for estate planning. In 2025, you can give $19,000 per recipient tax-free, without affecting your lifetime exclusion. For married couples, gift splitting allows combining exclusions, doubling the tax-free amount. This strategy accelerates wealth transfer and reduces estate size. Imagine giving $38,000 to each child tax-free, significantly lowering your estate's value. Repeating this annually can move substantial wealth out of your estate. Gift splitting is a potent way to mitigate future estate tax liability. Let's explore the lifetime exclusion and the looming 2026 changes. Understanding these strategies is key to effective estate planning. The lifetime exclusion is crucial in estate planning, allowing tax-free transfers up to $13.61 million in 2025. For couples, portability doubles this amount, shielding $27.22 million. However, this high exclusion is temporary, set to halve in 2026. This estate tax cliff urges immediate strategic planning. A $10 million estate faces no tax now, but could owe $1.2 million in 2026. The next year and a half is critical for leveraging the current exclusion. Let's explore strategic gifting to navigate this impending change. With the 2026 estate tax cliff approaching, strategic gifting is vital. Use the high exclusion now to transfer assets tax-free before it decreases. Gifting reduces your estate's size and removes future appreciation from tax. For example, gifting $5 million now avoids future tax on that amount. Combining large gifts with annual exclusions maximizes tax-free transfers. This approach minimizes your estate's future tax liability. Consider gifting appreciating assets to avoid tax on their growth. A multi-pronged gifting strategy is essential for effective estate planning. Let's navigate the necessary IRS forms for these strategies. Estate and gift planning involves key IRS forms, Form 706 and Form 709. Form 706 is filed after death if the estate exceeds the exclusion amount. It requires a detailed inventory and valuation of assets and deductions. Form 709 is for gifts exceeding the annual exclusion, documenting lifetime exclusion use. Filing these forms correctly is crucial to avoid costly errors. Seek professional guidance to navigate these complex requirements. Proper documentation ensures compliance and maximizes tax benefits. Understanding these forms is essential for effective estate planning. Let's wrap up with key takeaways for safeguarding your financial legacy. For expert help with estate and gift tax planning, contact FSMC Bookkeeping Services. Our team of CPAs, tax attorneys, and trust department heads is ready to guide you. Remember, the best way to avoid or reduce estate taxes is through proper planning. Reach out today to secure your financial future.